Investors waiting to hear, meanwhile, from Fed Chair Jay Powell this afternoon at the conclusion of the central bank's two-day policy meeting. Our next guest says she expects the Fed to remove its tightening bias but remain cautious. Let's bring in Meghan Graper. She's the global co-head of debt capital markets at Barclays. Meghan, thanks so much for joining us. So I think the idea of a March rate cut is off the table now. What should we be looking for from today's press conference?
Yeah, I mean, I think rates unchanged is all but a foregone conclusion at this stage, as you suggest. I think really it's the signaling around the path forward that will be the more closely watched piece of the equation this afternoon. And I think what we're likely to see is a much more hawkish bias to the rhetoric at today's press conference in particular. I mean, certainly more than we're seeing priced into the market, with a 45% probability still reflecting, in my view, far too much confidence for a March Fed cut. There's a decent amount of data that I think suggests the Fed should approach today's meeting with, and the onset of cuts, frankly, with a healthy dose of skepticism. I mean, we've got financial conditions that have eased for 3 months running. We're continuing to see strong employment figures. We've got JOLTS data this week. I mean, there's a growing number of job openings. And then you've got CPI, which is just consistently running more than a point higher than PCE. So between those three things, I think the most likely scenario is that the Fed looks to buy their time here and to ultimately preserve some optionality before concluding that conditions are supportive of a more sustained return to target.
It's interesting. You mentioned the potential for a hawkish bias. I mean, we certainly saw a very dovish Powell in the last press conference and his comments. That's what gave us that end-of-year rally last year. What makes you think that they're going to not pivot again necessarily, but perhaps show a more hawkish stance at this meeting today?
Yeah, I think we saw some of this backing away of an expectation that cuts are imminent from much of the pre-blackout speech. So I think at a minimum, we should expect to see Powell echo some of what Waller's pre-blackout comments suggested and to temper any expectation of a fast or a sharp cutting cycle, which is certainly what the market is pricing in.
Meghan, you mentioned all the things that make it seem as if maybe the Fed doesn't have to be in any hurry, right, with financial conditions easing and economic growth holding up pretty well. The other side of that, and a lot of people are trying to kind of send around the 6-month average core PCE charts, that show, hey, we're pretty close to target. And here we are with a 5.25 plus Fed funds rate. The Fed has already said they'll be cutting before we're at the inflation target. So I wonder if people are just triangulating, where rates are, what the trajectory is on inflation, and if inflation is doing what it's doing and it's cooperating, we don't have to worry about the secondary things like financial conditions.
You're exactly right. I do think they're going to leave the door open to evaluating March. In fact, our economists at Barclays are calling for March as a potential first cut. But I think it's not a surefire thing. And certainly they want incremental data to support the fact that we're not actually going to re-accelerate. I mean, that's really the risk here. I don't think they want to get over their skis and be premature or overly aggressive out of the gates here. They can be patient. I think that's an every other meeting cut as they initiate some of these moves. So I think they'll open the door to March, but I think PCE in and of itself, while certainly suggestive that they've met that 2% target, there are enough other counterbalancing forces, CPI being one, that would suggest that there's still some contagion risk to that. So we need to keep an eye on it, and I think they will be patient in the way they proceed going forward.
And looking at the rest of the year, the market is hoping for, at least perhaps 75, 100 basis points in cuts. What do you think we'll get? I mean, the consensus is that rate cuts will start in June or July. What do you think we'll end up the year at when it comes to the Fed funds?
I do think we probably see 3 or 4 cuts this year. So that consensus is in line with our thinking. And I do think it could be as early as March, dependent upon the data. So, and then I think we see incremental cuts, another 4 next year as well. So we've got 2 years of a more prolonged path back towards normalization, in line with the market and frankly, in line with how many investors are positioned. So Fed funds aren't always a great indicator of the path forward. Talking to buy side players, hedge funds, asset managers, insurance companies, I don't think anybody's anticipating this to be an aggressive move by the Fed, certainly not in the first half of this year.